Joining us right now is Jay Clayton, who's the former SEC chairman, also a CNBC contributor. Jay, you watched 60 Minutes last night. Your reaction to what President Biden had to say?
Well, look, on the one hand, he's right in that focusing on inflation is probably one of the most key things for Main Street America. But people don't pay inflation, they pay prices. And we should actually start talking in terms of prices. If you look at, let's just use simple numbers. If you look at inflation being 10% over 1 year, going from paying 100 to paying 110, if it comes down to 5% the next year, year on year, you're still paying 115 and change. Prices are still going up. People are focused on prices. So, look, some leading indicators on this, or some important indicators on this. Average household spending is going up, $400 to $500 a month. That's roughly $5,000 to $6,000 a year. That hurts. Mortgages, $500,000 mortgage is going up by $1,000, $1,000 a month. That's going to have an impact on prices. I think we should, when we communicate to the American public about economics, we should go with things they understand, like prices as well as inflation.
So what would you say? I'm going to put your political hat back on. If this was the situation that you found yourself in, what would you say? What would you say to the American public?
I would say, look, a very positive thing. As far as major economies in the world, the U.S. is the best positioned to deal with the dislocations we have. In energy, in food, in logistics, even in inflation, we are the best positioned to deal with it. Tell people that. That's good news. The bad news is each one of those is substantially dislocated right now. And we're seeing that play itself out in asset prices and financial instruments.
We're waiting to hear what the Fed is going to say. And in terms of what do you think the Fed is going to say? What do you think they should say? The 2-year note, by the way, we're getting close to 4% here.
Yeah. Well, look, what Jay Powell, Chairman Powell, said in his last speech was actually important. He was communicating with the American people saying, look, in runaway inflation, we know from history that that's really bad. You can't plan at the household, you can't plan at the business. Everybody pulls back, okay? So we need to get it under control. But he also said that the causes of inflation that we are facing are not just monetary policy. There's a lot else going on, which to him means you're going to feel some pain. I thought it was a very responsible statement that, yes, we're going to play our role to get inflation under control, but you have to understand that it's not a surgical instrument. Interest rates are not a surgical instrument. They're a blunt instrument. And you're going to feel pain in a bunch of places.
Jay, just part of the cure adds to the pain, too, though. You talked about a $500,000 mortgage going up by $1,000 a month. That's because of higher interest rates. That's because of exactly what the Fed is doing. So, that's kind of difficult to explain to people, too. We're helping you by hurting you.
Well, you're actually showing how it's not a surgical instrument. Everybody who already has a mortgage and already has a home, their payments aren't changing. It's the people who are new entrants to the market or people who have floating rates. This is the kind of thing that makes this so difficult.
But that also means that people aren't going to move. It makes it much more expensive to move, which means, the builders aren't building. They've cut back. There's not going to be new homes that are coming up because people are moving and moving into different places. Well,
you guys had Barry Sternlicht on, and I always like listening to him because what he was saying in essence is, look, the demand destruction is not uniform. It's going to be acute in some spaces, and we really need to watch whether the acute demand destruction is going to have ripple effects.